Management launched the world's first institutional blockchain fund in 2017 before digital assets ETFs, institutional custody, and regulatory clarity existed in this field. They've been in the game for 7 consecutive years. In this chat, Yannis Georgandelis, CIO of BAM, shared what separates institutional-grade digital asset management from the noise, how multi-manager diversification saved investors from exchange collapses, and why wealth managers can't afford to ignore this asset class anymore. Yannis, welcome to the Zinnia Media pod. Happy to have you here.
Hi, Leonardo. Nice to see you today.
Let's start a little bit with some background. Block Asset Management launched the world's first institutional-grade blockchain fund of funding in 2017, when most institutionals were still early in the journey, and this was exclusively perceived for retail speculators and libertarians. As CIO, what gave you the conviction to build such a firm in a market that there was barely no institutional player?
At that time, the market was so small and the blockchain technology was so promising with many use cases that we thought this is going to grow exponentially. And therefore, we came up with this diversified fund of funds offer, which would allow investors to invest in the sector, to invest in the whole digital asset class without taking unnecessary risks, the risk of collapse or failure. We thought, okay, adoption is going to come, and as a matter of fact, that's what we saw in the last couple of years.
Yannis, now let's dive a little bit more into the institutional adoption compared to other alternatives such as private equity, real estate, or venture capital even. Digital assets is a much newer asset class. How are you seeing institutional adoption?
We've seen the new Bitcoin and Ethereum ETFs being launched, and this has been a major event. And of course, with the regulation in the US, the Clarity Act, the Genius Act in favor of stablecoins, and the MiCA regulation in Europe, this has validated, legitimated cryptos as a valid part of a portfolio. And therefore, institutions now are increasingly looking to diversify their allocation into cryptos.
It's very interesting what you just mentioned, because I remember a few years ago where the big wirehouses, the executives of the big wirehouses were denying it, and they were saying no to the asset class, and now they're all in into digital assets in that regards. Let's jump a little bit more into the investment side. Yannis, you as responsible of your firm, why multi-manager diversification matters in this field?
I think for one simple reason, you shouldn't put all your eggs in the same nest. This is just a basic rule in life. Everything could happen. You can have an exchange going bust. You can have a collapse for single asset managers. So you're much better off diversifying into several managers. Plus, it's going to reduce your risk, the risk of, losing your assets, and it's much more robust.
What's Yannis, do you think it's the biggest red flag when you analyze a fund out there in the market?
Of course, you need to see auditors, you need to see good quality service providers, fund administration, which are going to check independently prices. You want to be sure that the assets are being owned by the fund, so you check all this, and then you need to see a proper diversification in terms of custody, in terms of exchanges, the risk of all those counterparties. You don't want to work with a fund using only one exchange, because we saw that with FTX. If this exchange goes bust, then the asset manager goes bust. Therefore, you need to be diversified.
Very interesting, crystal clear. For investors out there, the most important part is doing the actual homework of due diligence. Let's jump more into the opportunity set, right? I mean, a lot is happening right now. Where do you see alpha in 2026, and how do you deliver returns in a down market when most crypto strategies are falling?
All right. So This year is undeniably a difficult year, complicated year for digital assets. I've seen a big decline this year. Therefore, in this market environment, market neutral is probably the best strategy. Market neutral is a very simple strategy where you generate absolute returns, something very stable, 10% a year. You buy a digital asset, a crypto at 10 on one exchange, and you resell it at 12 on another, and you take the spread. Or you buy a Bitcoin spot at 10 and you sell it at 3 months with a future at 12. You take the spread, or you provide liquidity and you get a 15% yield on decentralized finance. All those strategies are, market neutral strategies. You don't take any risk of, decline. And probably in a market which is difficult, it's the best approach for this year. But there will be opportunities to get back to, let's say, a participation strategy, buying back Bitcoin, Ethereum, and altcoins through, let's say, a more traditional strategy.
Super interesting there, Yannis. In other words, the buy and hold strategy for most investors of buying Ethereum and Bitcoin, which are the two biggest ones out there in the market, is not enough, right, as a strategy.
It's absolutely not enough. And as a matter of fact, for our, let's say, traditional diversified participation strategy, we've been hedging our positions. So we managed to reduce our long positions to only 30% of the portfolio instead of being invested 100%. I think that this provides a lot of value for investors because it's going to reduce the downside and the volatility. And hopefully then when the cycle is past, we can focus on the recovery.
One last question. BAM has been doing this since 2017. You've seen multiple cycles, good ones, bad ones, regulatory evolution, institutional adoption waves, spectacular failures as well out there in the market. Looking ahead 3 to 5 years, what does the institutional digital asset landscape actually look like?
It's the first time that I see deep value in this sector. When I look at valuations of some protocols in decentralized finance, for example, you would pay 5 or 6 times the earnings, the cash flows. You could even argue that for some sectors, some projects, some altcoins, valuations are 3 times cheaper than US equities. So there is really deep value in the market as a result of lack of liquidity, and this gives me a lot of hope, and that once the current correction phase is done, then we're headed towards a major recovery and major expansion.
Thanks a lot, Yannis, for your time. It's been a pleasure to have you here in the pod. Let's see how the market will perform over the next few months. But overall, the message here as well is do the homework, do the due diligence, and at the same time think outside of the box. And apart from looking for Ethereum, Bitcoin as a standalone solution, there are other strategies out there in the market that could help you build alpha in the portfolio. Thanks a lot, Yannis, for your time.
Thank you too.